Hi. Couple of things I want to discuss today. We've got US unemployment at a one-year low, alongside inflation due to drop sharply next month. That's headline inflation. Looks like to me we're in a Goldilocks economy. And second of all, we've got Q2 earnings coming through. What's the outlook for equities? Hi, welcome to another Super Macro podcast. My name is Elvis. Sitting opposite me, as per normal, veteran hedge fund manager and the author of the Super Macro Note, Jonny Matthews. Hi, Jonny.
Hi, Elvis. How are you?
Yeah, I'm pretty cool. We've got a few things to discuss today. What I want to talk about first of all is a recap of the non-farm payroll data that came out last Thursday. What are you seeing there?
Well, it was mixed. And let's face it, there was something in there for everyone. For the bears, the perma bears, who were always looking for a recession. They will point to the slowdown in job growth.
Can I make a joke about billion recessions coming, that's been predicted,
Well, let's face it, we've heard it for a long time, starting from when the yield curve first inverted a few years ago, then the SARM rule was triggered.
Any excuse to find that there's going to be, and there hasn't been one.
Well, there hasn't been one since the pandemic, certainly, and the decline in payroll growth. Just to recap, job growth was 57,000 in this latest report for June, slower than the prior 3 months. But as you rightly said, the unemployment rate dropped to 4.2%.
But as we get to full employment, Jonny, surely it's difficult to grow that many jobs every month continually as you get close to full employment.
I think that's the supply of available workers is shrinking.
Well, yeah,
without a doubt.
Yeah, that takes us to chart one, I think, isn't it?
Chart one, I want to. If we look at chart one, I think it's best to look at this from a longer term perspective. And let's face it, last year obviously we had the government job cuts. And on average, the US added just 10,000 jobs per month.
What's that, 2025?
In 2025. So far, this year to date, average job growth has been 92,000 per month.
Okay.
So we're already on to...
But that can be revised. And at the end of the year, it's invariably revised lower, but...
Well, it may not be revised. There's no guarantee it's going to be revised lower. Sure, there's the quarterly survey that's done, the benchmarking revisions that they get done annually. But
on the face of it, solid growth in jobs
on the face
year to
of
date.
So far, much better than last year. And in fact, if you look at the 12-month average, which is on that chart, you can see it started to trend higher.
The red line, yeah.
And obviously, within that 12-month average, you still have you've got the government job cuts.
Shedding jobs last year, yeah.
Yeah, but it started to trend higher, which is a good sign. Now, the drop in the unemployment rate was kind of strange, but largely driven in June by a lot of people just leaving the workforce.
Yeah, participation rate went right down, didn't it?
Yes, but you've got to bear in mind that survey is just 60,000 households. Yeah. It's a very small survey.
How many people in the workforce?
170 million employees.
So they've got to expand that data of 60,000 to cover,
it's supposedly a statistically...
Make a lot of assumptions, in other words.
Yeah. So they go door to door, or some of it's telephone interviews, asking one member of the household, basically what the employment status is of the household. Are people employed? And if they're not employed, are they? And they
extrapolate that to cover the whole of the working population, in other words.
That's right.
Right.
Okay. So it's not that accurate, but it is what it is. It is what we've got, and as you rightly said, it's dropped to a one-year low.
Something you mentioned, that the workforce is the amount of people in the workforce is becoming is stagnant or dropping. Yet chart 2, which shows pay growth, I'd assume that pay growth would start to get higher wage gains.
Well,
if there's less people to choose from.
That's true. So far, we haven't seen it really. We've seen pay growth just picked up slightly in the June print from, I think, 3.4% year-on-year average hourly earnings to 3.5. Average hourly earnings is not a very accurate way of tracking wage growth.
Yeah.
It's thrown around by changes in the mix, like during the pandemic, after the pandemic, when a lot of low-paid leisure and hospitality workers lost their job, average hourly earnings shot up.
Is it the Atlanta Fed one you mentioned in the note, didn't you?
Yeah. So on this chart, if we go to chart 2, I'm showing there the Atlanta Fed wage growth tracker, which has been trending lower. And the red line is the ratio of job openings from the JOLT survey to the number of unemployed.
And that's picked up a little bit recently.
That's picked up.
Yeah.
And, you know, I wouldn't read too much into it. It's something, but you've got to bear in mind the JOLT survey has quite a low response rate as well, and we're comparing it to the unemployment rate from the household survey. So the data are not super accurate, but if you look at the previous trend in this, you know, it did help. You know, prior to the pandemic, a higher ratio of job openings to unemployed did help drive up pay growth.
Well, you assume it would do, wouldn't it? Just basically, there's more jobs available, less the same amount of people, so therefore you pay a bit more to get the people on board.
One would hope so.
That's what
one would hope so.
I'd
Because
assume.
up to now, to be honest with you, you know, Labour's share of the economic pie has been declining.
Yeah,
it is.
I
I
think Elon Musk got it all, didn't he?
He's got most of it. Yeah. So yeah, I am hopeful that we will see a pickup in pay growth if this trend continues.
Yeah. Okay.
And one other thing I do just want to point out that we've had now 2 months where there are more jobs available than unemployed workers. That ratio has gone back above one. And that was something that Powell used to pay attention to.
Okay, fair enough. Let's just move on to inflation.
Yeah.
Now, a lot of inflation expectations have been coming down. I think Warsh mentioned that, didn't he, in his last speech at, is it Sintra? Was it Sintra?
Yeah.
And I can see in this chart 3 that the services, excluding energy services, it makes up a big proportion of the CPI.
Well, that's the thing. This is the issue here. I mean, if you look at the components of inflation, obviously energy had a big impact over the last couple of months, and that will have the opposite impact going forward. It's going to be a big drag on headline inflation over the next couple of months. We know that because the oil price has collapsed right back down. But you know, when you look at the components of inflation on this chart, core services, you can see the red bars here. Not only are they trending higher, services inflation never really got back to where it was prior to the pandemic. And then you have core goods inflation in the green. Well, it was negative for a short while. That was kind that's kind of an like a base effect, an echo from the pandemic.
And
shortages.
the volatile bit is energy.
Yeah, but just focus on the green and the red. These are the components of core inflation.
Right.
And both are trending higher. Now, core goods, part of that is tariffs. But, you know, really it's all a symptom of deglobalization, if you like.
So these inflation expectations that have been, I can see the data's been, you know, it's been coming lower. Is that just a product of the oil price?
Well, you can trade inflation swaps, CPI swaps, and the most dominant factor driving that is the oil price. Right. Now, obviously, if you're looking out over the next few months, comparing where the oil price is to where it was, you know, it's dropped from $120 a barrel. Now we're down at $70-something a barrel. It's gonna shave off quite a bit from CPI inflation.
Do you want to move on to the treasury curve? You've got more to add on this.
Yeah, I will say this. First of all, CPI, you know, if you talk about inflation expectations, CPI swaps are driven by the oil price. But secondly, consumers' inflation expectations also very heavily dependent on the price of the gas pump prices.
Yeah.
And you know, it always astonishes me how much weight some people put on inflation expectations from consumer surveys.
Yeah, because they've got 24-litre engines in their cars.
I think the thing is, because it's one of those purchases that people make frequently, once a week, they notice the change in the price.
So Jonny, what do you think the Fed's going to do, or more importantly, what Warsh is going to suggest the Fed do or does?
Well, that's a good question actually, because we had his first FOMC meeting was quite a surprise to the market. He was perceived as being more hawkish, but obviously, I mean,
can we use the word sensible rather than hawkish?
Okay, sensible. Look, don't forget the dot plot shifted up quite a bit.
Yeah, so he had to acknowledge that.
But in his press conference, obviously he wanted to give minimum guidance, but he did come across as more hawkish than was expected. And you can see if we look at chart 4, it's the yield curve, the spread between the 10-year yield and the 2-year yield. The yield curve has been flattening this year. You know, it was kind of a consensus trade, the curve steepening, the debasement trade and everything.
Yeah.
And then people started to get cold feet, thinking maybe Warsh won't be quite as dovish.
You wrote about that in the note extensively. I remember reading that.
And then at the FOMC meeting in June, you can see
it moved dramatically.
It flattened right the way down to about 25 basis points, that spread between.
On him being perceived as hawkish.
Yeah. And what happened was the 2-year yield jumped 13 basis points on the day, I think, 10 or 13 basis points. And the 10-year hardly moved.
Right.
So that spread closed up considerably. And then last week,
must have got a call from Trump. I'm not happy about this. Can we?
Well, that's very cynical of you. I don't know if it was quite like that, but the phrase that he used last week was that he said, and I'll quote it here: expectations of future inflation have come lower over the past 4 weeks. Have come down, and inflation risks have come down, and you can see the impact there. So the market then decided, okay, maybe he's not going to be quite so tough on inflation.
You think he's latching onto data that fits what he really wants to do, or first of all doesn't want to raise rates and then eventually wants to drop them?
Well, he's spoken about. Obviously, he's got all these task forces. One of them is going to look at data collection and reporting methods.
Which one suits? You should have which one suits task force.
That seems to be it. And he's spoken about the trimmed mean measures.
You mentioned it earlier. Yeah.
Yeah, and I think I was thinking about this the other day. That obviously they're very slow moving. They're lower than core inflation. It would suit to focus more on trimmed mean if you're trying to create an argument for not raising rates. But
will the market buy it?
I don't think the market will. And I'll give you a prime example, because these trimmed mean measures, they strip out the outliers. In any month, the prices that make the biggest upward moves and the biggest downward moves get stripped out, and you do a mean of the rest. But just think, I know that Apple isn't a massive part of Apple products, are not a big part of the CPI basket, but they do a price hike of 20%, as they did last month.
It doesn't find its way into the measure.
That would be stripped out of these trimmed mean measures. But as for you, I mean, fine, it's a one-off price hike and you don't buy an iPad every month, but from now on, you're going to be paying more for your Apple products.
That expense is 15 to 20% higher, finished.
Absolutely, and it's not going to come down.
And that's this year. Well, I assume it goes up next year as well.
Who knows? But it's certainly not coming down.
Yeah.
That's the thing. So there are, and that's just one example. If you think Netflix also, I think they hiked their subscription prices between 8 and 12%, I believe, this year.
We think how many customers they got in the US alone. That has to affect part of the basket somewhere.
It's a big jump. Streaming services is it's got whatever weighting it's got in the CPI, but that's a big jump. It'll have an impact. And if you're stripping out all these outliers, you're not really getting
you're getting a number that suits you. It comes back. You've mentioned this before, and in the note, and we talked about it at these podcasts, the supercore inflation that Powell used until he didn't like it.
Yeah. Well, it's interesting that you mentioned that, because at the time, housing was a negative influence on CPI inflation and PCE inflation. Rental inflation was slowing quite sharply. Just recently, if you look at the more high-frequency measures like Zillow's measure or apartment list, rental inflation has begun to tick higher.
To pick up again.
Yeah, so it will no longer be a drag on inflation.
So, net, you don't think the market's going to buy his measures that he'll want to use to conduct policy?
I think there is a risk that if the Fed becomes too dovish or is perceived as being too dovish, we could finally see long-term yields break through these thresholds that I've spoken about. 4.5% seems to cap the 10-year and 5% caps the 30-year.
Yeah, it seems to gravitate around those two levels at the moment.
And at some point, I think these yields will break through. We're just in a much higher nominal growth economy, and I think that's the bottom line. And rates will be higher going forward.
That brings me on to my second question I wanted to, or not second part topic I wanted to discuss was equities.
Yeah.
S&P, Q2 earnings data will be coming out.
Chart 5. Well, okay, let's put it this way. Earnings growth was extremely strong in Q1. It's expected to be strong in Q2, and as happens most quarters, 80% of the companies that report beat the estimates.
Isn't that a surprise?
But I think that, I think there are headwinds that are picking up now. And if you look at chart 5, if you look at the actual S&P index, which is the red line, and the 12-month forward earnings per share projections,
it looks healthy from here.
That's right. The earnings projections have gone up faster actually than the index, which means
the multiples are less.
Yeah, the
forward
multiples has compressed just a little bit, but the pace of earnings growth is beginning to slow down in the forecasts. And let's face it, the S&P has chopped around for the last few weeks, and I do think there are headwinds picking up. We're certainly seeing it as far as trading is concerned. And I've spoken about it previously. There is this enormous churn between different sectors.
Yes.
And I think let's go on chart 6. So I showed this chart last week, but there's been this movement not only between the tech sector and other sectors like energy, healthcare, whatever. That also within the tech sector, there was this strange moves between the chip makers and the chip buyers.
I like how you phrased that. That's very clear. The chip buyers are paying for this, and that's why we've seen the Mag 7 struggling. Yet the people producing the chips, which you've got a list of the names, I think it's in the next chart, but they've been doing extremely well.
And the prices are going higher. There is this insatiable demand at the moment. But what we've seen over the last couple of weeks is that these two cohorts of the same sector, the tech sector, are not moving in the same direction on a week-by-week basis. So last week, the chip stocks
lower,
and the hyperscalers went up, and the week before it was the reverse. There is this breakdown in correlation, and previously
the water looks calm on the top if you look at the index, but underneath it's flying around all over the place.
Yeah, I mean, if you look at these two previously, they were very well correlated. They did kind of move together,
which you'd assume they would do.
Yeah, but I think what's going on is that there are headwinds mainly facing the hyperscalers and their massive spending. I mean, Meta last week announced that they're going to be selling or leasing out their excess computing capacity.
Isn't that a surprise?
And the shares went up 10%, and then companies that kind of specialize in that activity, leasing out data centers and so on, like CoreWeave, their shares dropped. But to me, this seems like a symptom of overinvestment, overspend, and excess capacity.
We need some return on the money we spent. How do we get it?
Yeah, and so we're forecasting something like 700 or 800 billion of spending this year, and something even greater next year by the hyperscalers. Maybe that will slow down.
And that could mean that correlation could then change dramatically.
Well,
because
who knows? I mean, who knows?
Memory chips might not be in such insatiable demand.
Well, chart 7, which shows the chip stocks, even within the chip stocks, there is this dispersion of price action.
Wow.
So it's really the makers of memory chips that really have been flying.
Yeah.
And, just over the last few weeks, they're beginning to falter. Micron Technology reported earnings a few weeks ago. I think it was the end of June. The shares went up after they announced their results, peaked, and now the stock is 20% lower. there is this extreme volatility within the chip sector, and it has been struggling over the last few weeks. But meanwhile, they're still putting their prices up. I mean, Samsung, I think,
20% or
20% price hikes.
Not bad.
Just can't fulfill the demand. And certainly there's more demand than there is supply.
Well, that was the excuse that Tim Cook gave us for the rises in the hardware that Apple sell.
Yeah. Yes. So I don't know, and what this amounts to for the equity market is, and I showed this chart last week, chart 8. I find this quite fascinating that the correlations, implied volatility of the red line is the average implied volatility of the single stocks, the top 80 single stocks
within the S&P,
and the blue line is the VIX, which, as most people know, is a 30-day implied volatility measure based on variance swaps.
Has it ever been that wide?
Never has this measure of dispersion been this wide in probably in the history of the universe, to be honest. But to be honest, I have, like I said last week, I used to trade this kind of trade, long a bunch of stock volatility and short the index.
Oh, they made them a lot of money recently.
It's doing fantastically at the moment. But what this tells you is that the individual stocks are becoming incredibly volatile, but they're just moving in different directions.
What happens if they start moving in the same direction?
If the correlation picks up, then the index volatility will really pick up.
And probably head south in price.
Well, it's kind of a chicken and egg thing. You could say, well, if correlation picks up, the index is going to move very sharply. But typically what happens is the index makes a sharp downward move and correlation picks up. Everything goes down. I'm not suggesting that this wide dispersion
it's going to happen yet.
It's going to happen. But at some point it will. At some point
that risk is building.
And I think the bottom line is the headwinds to the equity market are building. We've got a possible Fed hike coming up in the second half of the year. We've got possible. I mean, it's
possible.
Priced by the market. Probable. Let's call it probable. We have the supply from Anthropic. OpenAI was delayed. We've got the SpaceX IPO has been successfully launched, but you've got the insiders. The lockup expires after 60 days, so potentially there's that supply as well. You've got Google, Alphabet rather, doing their equity raise.
So, Pete, there's plenty of stuff chipping away at liquidity, in other words.
Well, there's a lot of supply coming. Let's put it that way, and it's beginning to resemble. I won't call it exactly a zero-sum game. It's not a zero-sum game, but it is beginning to resemble that in the tech space. In that, this is kind of turning into a fight for dominance. There's going to be one or two
winners, and then
a lot of losers,
who spent a lot of money.
And it seems to be the same thing in the chip sector. These companies will eventually. Well, we saw Hynix and Samsung have announced big investment plans. Those plants, those fabrication plants won't come on stream for another 2 or 3 years. But who knows what the outlook will be, what the demand will be for chips.
Okay, Johnny, you write about this every day in the notes.
That's right.
I read it, I vet it.
Yes,
I get my information from there.
I find it's a great help for my trading.
Yeah.
If I do a lot of research and I write it all, if I can explain what's going on in markets and why they're doing what they're doing.
It clarifies or makes it clearer to you what you should be doing.
Exactly. It really helps. And so I do a daily note and then a weekend summary. And in the weekend summary, I go into more detail about the markets.
Right. So where can you read this daily?
So if anyone wants if anyone else wants to subscribe, you can get a free 30-day trial subscription at super-macro.com. And then after that, it's £50 a month if you take up the subscription.
Look, to be honest with you, I highly recommend taking a subscription, especially the 30-day free trial, reading what he puts out, it helps me trade, and it fills in the blanks that I would not normally know.
Thank you.
Thank you, Jonny. And just one mention to hurrah for England last night. Fantastic. Oh, sorry, this morning rather. 3-2, 10 men. Fantastic.
Well done those that stayed up to watch it.
And sets up Norway at the weekend.
Yep, thankfully we've got a quiet week on the data front this week.
Okay.
But we'll be back next week, I guess, with another show. So
thank you, Jonny.
Elvis.
Thank you.